to Thicc Latin Gets Mind Banged, the podcast. I'm the Thicc Latin Getting Mind Banged, Blake Lewis, and this person right here is Kyle O'Brien, the one doing the banging. We're two seniors in college, and there's something that we realized. There's so much unknown in the world, and Kyle's job today is to really just blow our minds with stuff that really makes the world go round. What makes the world go round? Today we'll be talking about the financial crisis of 2008, and Kyle here will royally fuck us in our mind. Kyle, take it away.
All right. So I'm going to tell this to you through a story, and I think it's important to really see the whole picture with this, because at the end we're going to see how all these different pieces come together. So I'm going to start with Joe Sixpack.
Joe Sixpack, who is
Joe
he?
Sixpack. He's the average American. Sarah Palin coined the phrase when she ran for president in 2008. She used Joe Sixpack to refer to the average American who went to work, worked hard, came home and drank a six-pack of beer at the end of the day.
Okay.
So you're Joe Sixpack. You want to live the American dream. You want to get a nice house, a wife, kids, white picket fence, maybe even a mistress on the side.
Fair. The American dream.
Home ownership is the cornerstone of that American dream.
Why is that?
It's what everything is built on. Your home is the most valuable thing the average person owns.
Okay.
It's where you live.
Okay.
It's where a lot of your life will happen. It is the cornerstone of the American economy and of the American dream.
Gotcha.
Because if you think about it, when you think about the American dream, it's a nice house in the suburb with a white picket fence, pool in the backyard, a wife and two kids. Maybe a nice car in the driveway. You go to work, you do your 9 to 5, you come home, you have a beer, you watch some sports on the TV.
Gotcha.
So, knowing that that's the cornerstone of Joe Sixpack's dream,
Yeah.
we go to the early 2000s. Home prices were soaring. And now, one important thing to think about with home prices is that there's a difference between a good and a financial asset. So, a good would be something like a refrigerator. If the price of a refrigerator went up 30%, you just wouldn't buy a new fridge.
Yeah.
No one would want it. But when the price of a financial asset goes up, people want them.
What's an example of a financial asset?
So in the early 2000s, what we're talking about is houses. People started treating houses like not a good, but a financial asset, something they could invest in and get a better return in later.
Okay.
And in the early 2000s, the media really began to propagate this. You would see commercials all the time with, get rich in real estate in 15 days. There was literally even one that promised that you could get rich in real estate with no money in 15 days. 15
Did
days.
people get rich, or?
I don't believe anyone got rich
Okay.
in that system. There is no 15-day get rich quick system. But people bought into it.
Gotcha.
And as the prices of houses kept going up, you would feel like a fool not to get into it. Not to start buying more real estate. So what did the average person do? Their financial advisor told them to take out a loan against their house. So if you owned your house, you could take out a loan to get money and your house would be collateral. Collateral being what the bank would take if you can't repay the loan.
Okay.
Financial advisors would tell people to take out every penny they can against their house and use it to buy another house.
Oh, okay.
And at the time it made sense. Prices were only going up. People were getting rich in real estate.
Gotcha.
And this became a problem when eventually all the people who really could financially afford a home had been expended.
What do you mean expended?
So a lot of people can't afford a home.
Yeah.
A person working at McDonald's can't afford a home. Bartenders usually can't afford to buy a home.
Okay.
And eventually everyone who could afford to buy a home had a home.
Gotcha.
But the banks wanted to sell more homes because they wanted more mortgages.
Well, why does a bank need more mortgages?
That's how they make money.
Gotcha. Okay, that makes sense.
They give you
was a simple one.
they give you $100,000 to buy a house. They get
interest.
They get 6% interest on it.
Gotcha. Okay, that makes sense.
They started looking to people with lower credit quality. For the purpose of this, when we talk about credit quality, we'll keep it a simple A through D system.
Okay.
A being the highest creditworthiness, D being the lowest.
Okay.
So when they exhausted all the A's and the B's, they found out people who were in the C and D range, people who you normally wouldn't give a loan to.
Gotcha.
These were famously called ninja loans.
That sounds cool as...
No income, job, or assets.
That's not
Giving
as cool.
loans to people.
That's not as cool.
It's not. It's really not.
Okay.
It was giving loans to people with no income, job, or assets.
That's
no money coming in every month to pay the mortgage.
It's a money move, okay.
No job, which would in the future give them the ability to pay the mortgage every month. And no assets they could sell.
But why would they do that?
So they could pay the mortgage.
How did they expect them to pay them back if they didn't have money, didn't have a good enough job to like get money? Were they not expecting to get paid back? Do we? Okay. Do we ever get into that, or is that just like?
I might get into that a little later, but you know, they don't do a lot of thinking.
Really? Okay.
They get greedy.
Fair.
And how they originally got these people to take these loans was they gave them what's called a variable rate mortgage. When a normal person gets a mortgage, there's very strict set terms. You borrow $100,000 over the course of 30 years, you pay it off with 3% interest per year. But to get these people who couldn't afford houses to buy houses, they offered them a variable rate mortgage.
And that means?
It means that the rate of interest you pay is varied. And how they got them to take the mortgages was, in the beginning, you paid no interest, so your monthly payments were almost nothing.
Oh, okay.
And then eventually, they would flip, and you would have to start paying interest. And in the case of most of the variable rate mortgages, the rate would become very high. To a point where there was no way they could ever hope to pay them.
Gotcha, okay.
But because the prices of homes were increasing so much, the bank always knew that they could take the house and make a profit.
Oh, okay.
So many began over-borrowing to buy real estate, borrowing more than they could ever possibly afford.
Gotcha.
Living way outside of their means.
Their means, okay.
Yeah, so Joe Sixpack now owns 2 houses. He's got one with his family, and he's got one that he rents, that he bought because it's a good investment. You gotta keep in mind, Joe Sixpack also has a pension and a 401k.
Okay.
And through the pension or 401k, an advisor or a company invests for you into lots of different things.
Okay.
So now that we keep all that in mind, let's look at this from the financial side. Why do banks make mortgages? They do it because they get an interest rate. But when a bank takes in a mortgage, typically they sell that mortgage. So you say you go to Wells Fargo and you take out a $100,000 mortgage. More likely than not, within a month, they'll sell that mortgage to a different bank or an investment company.
Okay.
So a different company will own the rights to that mortgage and your checks will technically be going to them.
Okay.
The way they do this is they do something called securitizing mortgages. Because one mortgage on itself might be risky. Because one Joe Sixpack, he might lose his job. He might not be able to pay his mortgage. He might default on it. But 1,000 Joe Sixpacks, what are the odds that they all stop paying their mortgage?
Mm-hmm.
The main 2 companies that did this, bundling the mortgages together into one thing, which essentially, I don't know if I really explained that well enough. When they bundle the mortgages, they take 1,000 mortgages or 10,000 mortgages.
Okay.
They put them all together, and they sell rights to pieces of that bundle.
Okay.
The 2 main companies that did this were Fannie Mae and Freddie Mac. The Federal National Mortgage Association and the Federal Home Loan Mortgage Corporation.
They sound like pretty ladies, okay, and they're not.
Yeah, Fannie Mae and Freddie Mac are their nicknames. They're fun little nicknames.
Oh, that's fun.
We'll see in a little bit, it gets a little less fun. They're what's called a government-sponsored entity, a GSE.
Government-sponsored entity.
Up until 2008, the meaning of that was pretty vague. No one really knew what that meant.
Okay.
Because there was somewhat of an implication that the government would back their debts.
Yeah.
But there was no promise. Something similar is if any average person were to make a deposit in a bank, their account would be what's called FDIC insured.
FDIC.
The Federal Deposit Insurance Corporation.
Okay.
After the Great Recession, when people lost all their money because banks went bankrupt and they couldn't get their deposits back, the government created this organization that would insure your deposits in a bank up to $250,000.
Is that still going around?
Yes. It is still pretty much every bank account a normal person would use is FDIC insured.
Is
meaning that if the bank were to go bankrupt, you would be insured up to $250,000.
Every single bank is $250,000?
Yeah, that's the limit on how much you can insure per account.
Per account. So, like, what's to stop me from just, like... Wait, I'm sorry. More important question. What if I'm a millionaire?
Yeah.
And I want to put all my money in one account? Does that mean that up until like $250,000, they're just like, nope?
Yeah, so, well, you would have to weigh the risk of what do you think the odds realistically are
That-
let's say Chase Bank isn't going to be able to give you your deposit back.
Gotcha.
There's no reason to think that your bank would not be able to pay your deposits.
Okay.
This was mainly something that came on in the Great Depression because there was what was called runs on banks.
Gotcha.
People would be afraid that their bank wouldn't be able to pay their deposits because on average, banks only keep about 10% of the deposits. They loan out the other 90.
So you're saying that as soon as I take money, like as soon as I have cashola from like, stripping,
Yeah.
or more likely being a waiter, something where I've got a lot of cash, and I give it back to the bank. What do they do with it? They just give it to like their...
So by law, they're required to keep 10% of their total deposits in cash.
Okay.
And the other 90%, they loan out to people in mortgages, business loans, things like that.
Have there ever been times where like I just feel like I don't know, I've like worked in a kitchen and like restaurants where like things have gotten super busy and like it's just like too much for like the bosses or like the company to handle or the restaurant. Have there ever been days where like they happen to run out of the 10%?
No, they don't because there are very big penalties for it. It doesn't. Not each individual branch has it. The company as a whole has to have 10% of their money in cash.
Oh, so not each branch? Like
no,
not
the company as a whole has to be able to cover deposits. Because by law, most banks can usually make you wait 24 hours to take out a large deposit, or I think it's up to 72 in some places.
Okay,
to take out an abnormal deposit.
Not abnormal.
It's not reasonable to expect your bank to have $75,000 in tens that you take out. So for a large request like that, they might tell you need to wait 48 hours.
I want it all in nickels.
For something like that, you would actually need to go to a state mint.
I know what that is.
Fun little side story. A man had to pay a $180,000 bill that he felt was unjust.
I saw
so
this.
he paid it in quarters. A truck.
He saw it on the internet, and like the guy just dumped like sack after sack, and
He
like
might have been like a parking ticket. I've seen those.
yeah, and he was like, "This is not fair."
Yeah.
I'd love to give people parking tickets.
But anyway, people would get afraid that their bank wouldn't be able to pay their deposits back in like the 1920s, and then all of a sudden everyone would show up at the bank at once and demand their money back. But because banks only carry 10% of the money they technically owe people, no, they couldn't give people their money back. They can't give everyone all their money back at once.
Okay.
The bank would go under in a day. All of a sudden, in a day, the bank would fail. And then when people heard one bank failed, they would assume their bank was going to fail, and they weren't going to be able to get their money back.
Ooh.
So there would be a run on all the banks.
Wow.
And anyway, that's where the whole FDIC thing comes from. Anyway, back to the main part of the story.
Okay.
Banks would sell their loans mostly to these two companies, Fannie Mae and Freddie Mac.
Freddie Mac, all dressed in black.
Yes. And they would bundle them into what was called a CDO, a collateralized debt obligation.
Okay.
Collateralized being the collateral that people had to pay, they would take if people didn't pay it off.
Okay.
Debt being the money they lend them, and obligation being their obligation to pay back that debt.
Mm-hmm.
The CDOs were these big bundles of mortgages that they securitized. So they would take they would take 1,000 mortgages, put them all together in one big bundle, and then sell off pieces of that bundle. Because altogether, it's way less risky when you bundle them all together. Because if you bundle, like we talked about credit ratings before, say someone's an A, and you have a B, and you have a C, and you have an A, and you have a B and a C. If you average it all out together, you have someone with like a B credit rating, and that's not bad.
Okay.
So by putting them all together, you can lower the risk of the overall package. And what that really did was it allowed banks to lend out more. Because they could have less risk by selling these mortgages and bundling them all together, lower the overall risk level, they could lend more. Because the risk level wouldn't be as high.
Okay. And this is all in...
I wasn't sure if I hit play.
So this is all in 2008, right? This isn't like...
So this has been going on since the early 50s.
No, I mean like this, like what you're explaining. This was all like bundling it up and selling it.
So they've been doing this since the early 50s.
Oh, okay.
But it really goes awry leading up to 2008. Really starting in the early 2000s when they start lending to people who aren't very good credit candidates. They're called subprime loans.
So, I don't think I'm jumping ahead, but is it safe to say that the entire financial crisis that we're talking about today would it have been avoided if they only gave loans to people who had enough credit to? Really?
Yes.
So
it's a very oversimplified way to approach it, but yes, in large part.
Yeah, no, there's definitely a bunch of steps.
There would have still been issues, but in large part, it wouldn't have been anywhere near as dramatic as it was. It would have been a minor recession like we had every 4 years.
When's the last time we had a recession?
We haven't had one in about 8. We're quite overdue. But historically, we have a recession is nothing to worry about in particular. It's natural. It's usually something the average American doesn't notice. It's a slight economic.
Oh, okay.
It's a slight economic downturn. A recession is not 2008. 2008 is by no means a recession. They just didn't want to call it the Great Depression Part 2 because that just sounds kind of stupid.
Yeah,
that's the only reason they call it the Great Recession, because the Great Depression was already taken.
It's not very cowabunga.
Yeah, Great Depression was already taken. So anyway, they would take all these mortgages and they would bundle them together. But increasingly as time...
Oh my! Oh, that was a baby blur.
But anyway, increasingly as time went on and they ran out of, good candidates to lend them to, these CDOs became filled with subprime mortgages.
What's a subprime? Mortgages
to people who weren't very good credit candidates. People who weren't incredibly...
Ninja loans.
Yes.
Okay.
Ninja loans were subprime loans. Loans to people who have less than prime credit.
Okay.
And one reason this was able to work was the credit rating agencies. There are 2 main credit rating agencies in America that do almost all of the credit ratings. Standard & Poor's and Moody's.
Okay.
Both of which had recently become public companies.
What does it mean to be a public company?
You're traded on the New York Stock. You're traded as a public company. Average person can buy shares in your company. And when you become public, there tends to be much more of a demand for you to have consistent, high growing revenue.
Okay. And like most companies that we know of, like Apple, Google, Yahoo,
they're all public companies.
Sorry.
These 2 ratings both became public, so they had a big demand to keep bringing in money.
Mm-hmm.
How do they get money? By rating mortgages, by rating CDOs, by rating companies for creditworthiness.
Okay.
And what they started doing was, because they knew that if a bank went to them and got a rating that they didn't like, they would go right across the street and get a different one.
Gotcha. Okay.
So increasingly, they started just rubber stamping these loans, calling them A's when really they were B's.
Gotcha.
Or calling them B's when really they were D's.
Competition is important in capitalism.
So they would bundle 100 mortgages together. And typically, if you were to bundle 100 mortgages together, it would be mostly A's and B's, and maybe a few C's. But increasingly, these were filled with D's and C's more and more, and the rating agencies would just stamp the whole thing as an A.
Gotcha, okay.
So now that we have those in mind of how the whole financial system works, we can go to 2008.
Wait, that was the intro.
That was just how the financial system all kind of works together. And you're going to see why it's all important as we go further into this.
Okay.
You're going to see why you needed to know what a CDO is, and why you needed to know about the ratings.
Okay.
And why you need to know about Joe's six-pack.
Gotcha.
The first real sign of trouble came in March 2008. Although, in hindsight, anyone could argue that there were warning signs well before that. But the first sign that people saw at the time was in March of 2008, when a company called Bear Stearns went under. One of the oldest and biggest investment banks on Wall Street. They were founded in 1923. You alright there, bud?
It was spicy. Yeah.
They were founded in 1923. They were one of the oldest and biggest banks on Wall Street. Very important. Billions and billions.
Are they around
now? No. They were one of the biggest buyers of these CDOs.
Gotcha.
The thing with CDOs is they don't return particularly a lot on a percentage basis. They might only return 3%. So they did what was called leveraging their investment. They borrowed money to buy more of the investment.
What does it mean to? What does it mean to buy your own? What does it mean to buy an investment?
So, you bought a piece of the CDO. You gave them $100,000. Say you gave the company that was selling parts of the CDO $1 million, and they in return promised you 3% a year in interest as a return.
Okay.
As far as investments go, 3% isn't great. But if you take that million and then borrow another $4 million, you can make much more. Because you only put in $1 million, but in reality you have $4 million in, so you're earning interest on $4 million.
Okay.
Typically, when you borrow that money, you do have to pay interest on it. But the interest you have to pay on the money you borrowed to buy the thing is less than you're getting in return. So when they sell these CDOs, these bundles of mortgages, what they're really promising you is a percentage of the mortgage payments.
Okay.
So as long as people are paying their mortgages, it's all good. You'll get a relatively fixed amount of money. But when people don't keep paying their mortgages, all of a sudden the money you get from that investment goes down.
Okay.
And then when you start taking out leverage, when you start borrowing money to buy more of this investment, you're taking a risk because you have to pay back that money you borrowed to put into it. You don't just lose the money you had, you also lose the money you owe.
Okay.
And typically with loans like that, you owe interest monthly. So you have to pay the people interest on a monthly basis.
Gotcha. Okay.
So when all of a sudden you're no longer receiving payments from the investment you made, and you still have to pay back the leverage you took out on it, it's a problem.
Yeah.
And if you take out a relatively modest amount of leverage, it's not bad. But in 2008, there was many banks who had 80 to 1. For every dollar they had $80 of debt.
Okay.
So that becomes a real problem. Because then, if you're leveraged 50 to 1, if revenue drops by 2%, you're bankrupt.
Really? Okay. What is that for like banks on average? Like in a good time, like right now, like what is a bank like?
It really depends on the type of bank. But typically,
like a small,
you wouldn't want to see it leverage more than 20 to 1 as a rough guideline.
Okay. So like,
because at 50 to 1, a 2% drop in income means game over. You can't pay the interest.
Mm-hmm.
You won't be able to pay it back.
Okay.
So keeping that in mind, Bear Stearns, they were one of the biggest buyers of these bundles of mortgages, these CDOs. And because CDOs don't return a particularly large amount, they took out money and borrowed and used that money to invest, thinking that they would get back enough to pay back the money they took plus interest and still make a good profit with that.
Gotcha.
So that they could increase the profits from these bundles of mortgages.
Okay.
Which, who doesn't pay their mortgage? It seems like a perfectly fine idea.
Yeah.
Everyone's going to pay their mortgage. But you got to remember, they started giving to mortgage people who couldn't possibly pay their mortgages. And remember how we talked about fixed rate versus variable rate?
Yeah.
Right around 2008 was when that variable rate kicked in, and people went from having to pay almost nothing to having to pay a monthly amount they couldn't conceivably pay.
Why did banks all make it like during the same time though? Wouldn't it be smart to like?
So that goes to a man called Alan Greenspan. Alan Greenspan is the villain of this story.
Fair. Okay.
He was the
he's the Magneto.
He was the chairman of essentially. He was the chairman of the Federal Reserve from 1987 until 2006. The chairman of the Federal Reserve is in charge of making sure banks don't get out of line.
Gotcha.
Remember when we talked about banks have to keep 10%?
Yeah.
He's the guy who decides how much they have to keep. He can make it higher or lower.
Oh, he picked 10? Okay.
Yeah, 10 has been the standard for a long time. He was in charge. He decides how much risk banks can take.
Okay.
And he didn't believe in telling banks how much risk they could take.
What?
Yeah. He famously took his oath of office, quote, with his fingers crossed behind his back.
He said that?
Yeah, because when he took his oath of office is to regulate banks.
Okay.
But he didn't believe in regulating banks. He believed that was bad for the economy and bad for the system. So he very famously took his oath with his fingers crossed.
Wow! And
decided he would let the banks do pretty much whatever they want. And at first they didn't do anything too crazy. But over time, they got greedier and greedier. And then right after he stepped out in 2006, it really all came to a head. They had made a lot of really risky decisions.
So are you saying that like when he left, things got like shitty?
Yeah. That was nothing to do with the fact that he left.
Oh, it just happened to be.
It just happened to coincide.
Like, is it like if he stayed, he could have fixed it? Or?
No, there was no shot he could have fixed it. No one on Earth could have fixed it. But he allowed these banks to take these crazy risks, like giving mortgages to people who had no earthly possibility of paying them back. Yeah. He was the man who allowed them to take these risks. And so they did.
Yeah.
Bear Stearns increasingly gave people these subprime mortgages.
Which is ninja loans.
They
Not like
they
cool
weren't-
ninjas.
Yeah. They weren't all ninja loans. Some of them had job and assets.
But they were still...
But they didn't make nearly enough to pay back the amount of money they owed. Or to pay the monthly interest.
Yeah.
That's how a lot of people felt. They didn't have nearly enough. At the time, so anyway, back to Bear Stearns, where we are. We're in March 2008.
Okay, this is when
the
thing happened.
Bear Stearns is worth roughly $20 billion.
Which is good for a bank.
It's a relatively large. $20 billion is a lot of money. It's
which is good for a bank, right?
It's a large institution. It was the smallest of the big ones.
Gotcha.
But
what were some of the big ones?
J.P. Morgan, Chase, Wells Fargo, Bank of New York Mellon, Citigroup.
Mellons.
Yes, we'll get to Bank of New York Mellon later. So increasingly, these CDOs have been filled with bad loans. And the one failsafe was that with these mortgages, you can take the house when they don't pay.
Yeah,
but in 2008, the prices of homes started falling. All of a sudden, these loans they had given for a $250,000 house now only had a house worth $100,000.
Oh, okay.
So the value of these mortgages they wrote took a huge hit overnight and were worth less than 50% of what they were. So all of a sudden, they had given these loans to people they knew couldn't pay. But they knew at the end of the day, they could always take the house and make their money back.
Okay.
But all of a sudden, these houses weren't worth anywhere near what they gave people to buy them. You see what I'm saying?
Yeah, I do. Okay.
So all of a sudden,
yeah,
these investments they had made, because to a bank, a mortgage is an investment.
Yeah.
All of a sudden, these investments they made were worth significantly less.
Mm-hmm.
Just to give you a little bit of a sense of how bad this was for Bear Stearns. About a year prior to 2008, and roughly the start of 2007 and 2006, their stock price was $150 per share. By March 2008, it was $30 a share.
Wow.
As more and more people defaulted, the company just started to lose money. Because remember, they had to pay monthly interest on the money they had borrowed to pay these investments, but all of a sudden these investments weren't paying out anywhere near what they used to because people weren't paying their mortgages.
Okay.
So they had to pay all these money to the people they had borrowed money from, and they weren't bringing any in.
So, are you saying that this brother bear, whatever this
Bear Stearns, yeah.
Yeah, same thing. These Jewish bears. Would you say that they're the fault of all of this? Like, would you say that they started all of it?
No. They're just the first one to fall.
Oh. They were the martyr.
Yeah. Increasingly, they were taking less money in and had to pay money out. And eventually, it just became unsustainable. And eventually, J.P. Morgan buys them at the end of March with a $30 billion from the Federal Reserve. The U.S. government gave them $30 billion to buy Bear Stearns.
Why? That's so weird.
Because they needed someone to buy it.
Oh, okay.
Because if a large institution like that goes under, people worry about the stability of the entire financial system. And they need people to believe that banks will be able to give them their money.
Okay. Yeah,
and
I forget that.
And if a large bank goes under, people all of a sudden will wonder if their bank is next.
Gotcha. So, like, that means that once J.P. Morgan bought the Jewish Bears, the Bernstein Bears,
they were essentially ensuring that they would back all of that.
But like that means that the people, like, let's say, like you and me had like a bank account from like the Bernstein Bears. Does that mean that like?
So people.
Our money is still okay.
So Bear Stearns is what was called an investment bank. They're not a typical bank that you would use.
Like checkings and savings.
No.
It's not. They're not a typical checking and savings bank. They take money and invest it. So you would give them money to invest. It wouldn't be like your checking account would be with them.
Gotcha.
You would have an investment account with them.
Gotcha.
And eventually, at the end of March, J.P. Morgan bought them with $30 billion from the Federal Reserve at a price of $2 a share. A company that just about a year earlier was worth $150.
Is $150 a share like crazy?
No, it's share price is all relative to the company.
No, yeah, that's what I assume. But like, what is Apple right now? Like per share?
Apple's like $270 a share, but the price per share doesn't really mean anything because Amazon's about $2,000 a share. But it depends how many shares there are, because shares represent a piece of the pie.
Yeah.
So think of a share as a piece of the pie.
Yeah.
How much that piece of the pie is worth depends on how small the piece is.
So companies can like.
If you buy one share of Apple, it's a much smaller piece of Apple than one share of Amazon is. One share of Amazon represents much more ownership in Amazon. Say for simple numbers, one share of Amazon represents 5% ownership in the company.
So why can't companies just split up? Like, why do companies have more or less shares? And shouldn't it be like a set number? Like
no, each company, you have a set number of shares when you go public, and you can't create more without a vote from the board holders because you dilute people's ownership.
Okay.
But when a company comes public, they have a set number of shares. It's still recording. When a company comes public, they have a set number of shares.
Yeah.
So essentially, you have a set how many pieces of the pie there are.
Mm-hmm.
So the share price really just depends on how many pieces of the pie there are.
Yeah, no, yeah, that's what I thought, but like I didn't know that different companies had different numbers of shares.
Yeah, different companies have a different amount of pieces.
I didn't know that. I thought it was all like. I guess I kind of didn't even consider it. Yeah, okay, that makes sense.
So the pie for Apple has way more pieces than the pie for Amazon. But just for a sense at how much value the company lost, they started about a year before this at $150 a share, and eventually sold to J.P. Morgan on the brink of bankruptcy at $2 a share. We fast forward to July 2008. A lot of small mortgage lenders began to fail. Much smaller, not the big names that everyone would know, but relatively big lenders started to go bankrupt. To help with this, George Bush signed in the Housing and Economic Recovery Act, which extended more credit to Fannie Mae and Freddie Mac to allow them to buy mortgages from these banks to kind of give these banks some relief.
Okay.
It also gave people a tax credit for buying a home to help try to raise home prices. Because when people buy an asset, it increases the price, and the more people who want to buy it, the price goes up more.
Okay.
So he thought that by giving people tax credits for buying houses, he would be able to increase the prices of houses, relatively increasing, which would also increase the value of the investments these banks had made.
Yeah, okay.
So that was his attempt in July 2008.
Did it work?
Well, I think you know the ending to this story.
Yeah.
If we then fast forward again to September, this is where things like really start to heat up. Both Fannie Mae and Freddie Mac were on the verge of bankruptcy. The government took them over. The federal government did what's called nationalizing them, making them a part of the federal government. They did this by giving them $100 billion.
What?
$100 billion. They did it. They bought ownership stake in the company at $100 billion. They had the company sell them $100 billion worth of shares in the company. Roughly 80% of the company, 90%. In total, they would end up giving Fannie Mae and Freddie Mac $187 billion.
What?
all said and done, they gave them about $87 billion. The two companies, up until this point, had lost 75% of their value. And these two companies securitized most of the mortgages in the United States. Most mortgages in the United States at this point passed through either Fannie Mae or Freddie Mac.
Okay.
And these two companies had lost about 75% of their value. So the government had to extend them $100 billion.
Where does it even find that much money?
That was September 7th.
Okay.
Fast forward to September 11th, 2008.
9/11.
Lehman Brothers.
The Lemur brothers.
Yes, the brothers Lemur.
Yeah.
The oldest and one of the largest investment banks on Wall Street. They were established in 1844. They were literally the oldest bank on Wall Street.
Okay.
On Thursday, September 11th, 2008.
September 11th.
Yes. On Thursday, September 11th, 2008, they posted a loss for the last quarter. A quarter is 3 months, so they said they had to say that in the last 3 months they had lost $4 billion, and that they needed someone to buy them, otherwise they were going to go bankrupt. So that weekend, the Secretary of the Treasury, Hank Paulson, one of the lead regulators of banks, and was one of probably 2 people in the country who were in charge of making sure the whole financial system is good and doing well.
Okay.
Him and the Treasury Secretary at the time, Ben Bernanke, called the heads of all the biggest banks in America.
Like who?
To their office. Jamie Dimon of JP Morgan, Sanjay Patella of Citigroup, Lloyd Gross of Goldman Sachs, Merrill Lynch, who would shortly be bought by Bank of America, the head of Bank of America.
I know Bank of America.
Yeah. Bank of America, the heads of all the biggest banks, Bank of New York Mellon, were all essentially all called down to the principal's office.
Okay.
And the Secretary of the Treasury, Hank Paulson, made it clear to them that the government would not be bailing out any more banks. That they were going to have to fix the mess they made. He told them, you guys are going to have to figure this out. If Lehman Brothers fails, you're all next and you know it. So it's time for you to put your big boy pants on and fix this.
Okay.
He sat them all down in the room over the weekend, but one of the big problems was no one knew what Lehman Brothers was worth.
Not even the brothers of Lemur?
It was hard for them to even tell, but especially for outside people, it took, over the course of the weekend, they had to untangle their books and figure out exactly how much Lehman Brothers owed and how much they needed shortly. What they knew was that on Monday, Lehman Brothers had to pay $5 billion in bills and only had about $1 billion.
So basically, they were on a race against the clock. They had one full weekend to come up with $5 billion and to figure out what they were going to do, or else every bank in America would collapse.
Not necessarily right, but a lot of them.
And basically, like,
it was thought that Merrill Lynch was next.
And like after, like, basically,
and if one bank, and if Merrill Lynch fails, who's to say that Citigroup doesn't fail next? Because Citigroup was thought to be next.
So there was no reason to believe that like any bank would like really stand against it.
It was thought that there was probably 4 or 5 that would stand of the big banks. He called in about 9 people from the 9 biggest banks. There's no way to know, but most people think 4 or 5 of them would have survived. Wells Fargo, Goldman Sachs, JP Morgan, Bank of America. They were financially in the best position, but the other banks were financially in a very bad position.
So if the Lehman Brothers did not, like, if everyone did not come together and save the day, the world as we know would be like...
That was relatively the thought. The thought was Merrill Lynch would soon follow. Because on Monday, Lehman Brothers was going to have to announce that they were bankrupt.
Wow, that is mind-blowing. Wait.
Overnight, one of the wealthiest and most well-regarded banks in America was going to be bankrupt.
We have no idea what went on in that meeting.
We do.
We do? Okay, what happened?
There's a lot of things that happened, but essentially, Secretary of Treasury Hank Paulson took 9 of the most powerful men in the world.
No, but like what happened? Because like, no, yeah.
We're getting there.
Okay.
Sat them down and told them they had to fix their mess. He broke them up into groups and told one group to figure out a plan for them for all the banks or one of the banks to buy Lehman Brothers. Told another one of them and then told the other group to figure out what Lehman Brothers was worth. Increasingly, they figured out they were having a very hard time figuring out what Lehman Brothers was worth.
Uh-huh.
The CEO of JP Morgan, Jamie Dimon, somewhat famously said, "No one here knows how to value a CDO." Because while the idea of a CDO sounds very simple, the actual way they're structured is such that you need a mathematics PhD to figure it out. The average person cannot understand what a CDO is worth. You need a PhD in mathematics.
Okay.
The actual way the instrument works is incredibly complicated, so when things don't work properly, it's hard to figure out what it's worth.
Okay.
So one of the big problems they were into was they didn't know what it was worth because Lehman Brothers held so many of these CDOs. By the end of the weekend, they had figured out that Lehman Brothers had roughly $85 billion in real estate.
Which is...
They had bought it at about $85 billion. It was now worth a fraction of that.
How much?
No one really, regular people don't exactly know, but, not probably less than 20% of what they bought at. So these banks were looking at having to eat $60 billion, $50, $60 billion.
Wow, okay.
By the end of the weekend, it was decided that there was no way that any of the banks could afford to do it. And on Monday, September 15th, Lehman Brothers filed for Chapter 11 bankruptcy, and overnight 25,000 people lost their job because Lehman Brothers employed 25,000 people.
Wait. 20... How much?
25,000 people.
25 in America.
Yeah.
How much is that? In terms of like how many people I know, how much is 25,000 people? Okay, wait. I'm a little
That
drunk.
didn't really make any sense.
I'm a little drunk. There are 300 million Americans, correct?
25,000 of them no longer have a job.
That doesn't
after
sound
that.
too much then.
It's a lot of people to overnight be jobless.
Okay.
Anyway, so anyway,
I'm a little drunk.
on Thursday, September 11th was really the first, not the first signs, but the first big sign.
September 11th?
2008. Thursday, September
Not a
11th,
good
2008 was really the first sign that Lehman Brothers was in big trouble.
Okay.
And on Monday, September 15th, they declared bankruptcy.
Meaning that
The fourth-
25,000 people lost their jobs.
25,000 people overnight lost their job. It was the biggest bankruptcy in U.S. history. By far.
Okay, okay.
And I believe the third or fourth biggest investment bank in America was gone. An institution that had been on Wall Street since 1844 gone, almost overnight.
Whoa.
That brings us to AIG. So we talked about how a lot of these CDOs contain mortgages that were less than good. So what they did was they took out insurance on it. They took out an insurance policy, not one like you or I would take where if we crash our car, but similar.
Yeah.
They went to this company called AIG, and AIG was an insurance company. They insured financial insurance. So if all these people all of a sudden didn't pay their mortgage, AIG would cover it. AIG allowed these banks to do what's called a credit default swap. If the overall credit rating of the bundle of mortgages was, say, a C, but AIG insured it, AIG had an A credit rating. So all of a sudden, you could rubber stamp that with an A.
Uh-huh.
And remember, earlier on we talked about Joe Sixpack investing in a 401k.
I was just thinking about Joseph Sixpack. Okay.
So the average 401k can invest in something with a C credit rating. So AIG is where we're really going to start to tie all the parts of the story together. Remember in the beginning I told you that you got to see all the pieces and they're going to come together?
Yeah.
AIG is really where you can see all those pieces come together.
What is AIG again?
It's a company. The company name is AIG.
Okay.
It's the American Investment Group, but everyone calls it AIG.
Okay.
They're the largest insurer of financial assets in the world.
Gotcha.
And so what they would do is they would insure these CDOs. The banks would put together these, mortgages, these bundles of mortgages, CDOs, that were in reality full of all C-grade mortgages.
Mm-hmm.
But remember we talked about the rating agencies earlier, and they would just rubber stamp them with whatever rating the banks wanted. Even though they would do that, the banks knew that they were risky. So they took out an insurance policy from AIG. AIG would say, well, if all these people don't pay their mortgage, we will give you the money.
Mm-hmm.
This becomes important because this is where we tie in Joe Sixpack.
Okay.
Joe Sixpack has a 401k. But with a 401k, you can't buy things that have a C credit rating.
Why not?
It's just against the rules.
Okay.
It's against the rules. It's to protect the average American because a C rating is very risky.
Okay.
C ratings aren't likely to pay. So if you have this thing that's got a C credit rating overall, it's not likely to pay. So Joe Sixpack can't have it in his 401k. So AIG allowed people to do what's called a credit default swap.
Okay.
AIG's credit rating was an A. And if AIG insured the C credit rating loans all of a sudden the rating of those loans was an A, because someone with an A credit rating said they would pay it.
Okay.
If the person with a C credit rating didn't. So now all of a sudden, Joe Sixpack can buy that bundle of shitty mortgages.
Mm-hmm.
All those C-grade mortgages of people who can't fucking pay.
Yeah.
Joe Sixpack can now buy a piece of it. Even though the banks know deep down, those mortgages are not good. But as long as the prices of houses keep going up, it'll be fine.
Mm-hmm.
We can take the house and we'll still make money. Prices of houses went down in 2008, and people stopped paying their mortgages. So all of a sudden, these things start becoming worth nothing. AIG had been insuring these, but the mistake AIG made was they insured more than they could possibly ever pay if everyone had to collect.
Okay.
If even like 30% of the policies they had issued, like the insurance policies they had issued, tried to collect, there was no way they'd be able to pay it. There's just no way they would have the money to pay it.
Mm-hmm.
So all of a sudden, AIG, the largest insurer in the world, wasn't going to be able to pay most of their insurance policies, which were now all of a sudden coming due.
Okay.
They had insured roughly about $1 trillion.
Okay.
And in 2008, up until they got bailed out, so up until about roughly September, they had lost $99.2 billion that year. From January to September, they had lost about $99 billion. And as mortgage defaults went up, they kept losing more and more money. On September 16th, one day after Lehman Brothers declared bankruptcy, the government knew that the system couldn't sustain AIG failing, because almost every bank in the world had insurance policies with AIG. If AIG failed, the whole system failed.
Okay.
Everyone failed. So the government stepped in and gave them $85 billion.
Where's the government getting this money?
Printed. None of it's real.
What?
It's all just writing numbers down on pieces of paper.
What?
So on September 16th, the government gives them $85 billion in exchange for 80% of the company. Important, they couldn't vote in like company matters. That was the deal with all the money they would end up giving out. They weren't allowed to vote in company matters. Because previously this was unheard of. The government never gave companies money in exchange for ownership stake.
Mm-hmm.
But there was no way they could let AIG fail. If AIG failed, the whole system failed.
Yeah.
Because every bank had insured these...
Quick hypothetical, what would happen if the whole system failed?
Anarchy. Because what if everyone's bank failed?
What would happen?
What do? All of a sudden, you're Joe Sixpack, barely skating by. You got $1,000, $2,000 in the bank. You use that to pay your mortgage, feed your kids, send them, get Jimmy glasses. That money's gone. Overnight. That money is gone. Because AIG, the people who insured the bad investments that your bank made, are bankrupt. So now, all you banks have these bad investments, and they're going to collect on the insurance policies that they got from AIG. AIG can't pay the insurance policy.
How did AIG become bankrupt?
So they had insured all of these CDOs.
Yeah.
And in good times, it was fine. Because no one who doesn't pay their mortgage, no one's going to collect on this insurance policy. But all of a sudden, people weren't paying their mortgage, and everyone needed to collect on their insurance policy. Collect on their insurance policy. And they had insured more than they could ever possibly pay. They had just way overextended. Say they had $100, they had promised to pay $10 million if everything went bad. They had $1 trillion in policies. Wow. So on September 16th, the government gave them $85 billion to keep them afloat.
Which they just made out of thin air.
Essentially, all money's fake.
All money is fake. Let's just put that on the record.
Yeah. They did it because they believed the system would collapse without it. In total, the government would end up giving them $180 billion. Later on, they would end up having to give them more money to keep them afloat. In total, it would end up being $180 billion that they would give AIG. AIG alone.
Did AIG... Okay.
So that was Tuesday, September 16th. On September 19th, Thursday, Secretary of the Treasury Hank Paulson realized that AIG wasn't the only one. Lots of these institutions were going to go bankrupt. Lots of these institutions were going to go bankrupt because they had given so many bad loans, and they were so overextended and had so much debt. So he went to Congress, and he famously asked for a bazooka.
I'm sorry. What?
His bazooka was $700 billion. He went to Congress and asked them for a bazooka.
Not an actual bazooka.
No. He told them that he couldn't do it with a small amount of money. He needed people to have faith that the government could handle and back it all if it really all went to shit. He needed a bazooka, not a pistol. He said that he didn't necessarily want to use it, but he needed people to know he had it. To keep the faith in the financial system. Because what happens when people lose faith in the financial system? They go to the bank and they demand the money. But the bank only has 10% of your money.
Mm-hmm.
Everyone goes and demands their money. The bank fails overnight. In one day, the bank can't pay its depositors, and people have entirely lost faith in the institution. And when you hear that your friend's bank isn't able to pay him his money, what do? You go to your bank and you ask for your money. And every other person does. And when that happens, your bank can't pay all those people.
So,
and the entire
why
system
are banks
crashes.
Why are banks a thing when I could just have cash?
You're gonna hold your cash in your house? It's not a great idea.
Why not?
It's just not.
If all banks failed right now, if I just flipped a switch and all banks failed,
the world as you know it is over. Wow. Because you don't have any money. No one has any money.
Holy shit.
So, September 19th.
So who really saved the world that day? Who really stopped all banks from failing? If you had to
Treasury and the Federal Reserve. They went to Congress and asked for the money to support the banks.
Okay, so you would say that man Hank saved the world.
In some ways, yes. He knew that, he told Congress the whole system will collapse if banks start to fail. And that he needed the bazooka. He needed people to know that he had a big, bad weapon to save the banks. He didn't necessarily want to use it, but he needed people to know he had it, so that they would have faith that if their bank went under, the government would save it. He asked for a bazooka. Literally a bazooka. He used the word bazooka. Wow. Congress denied it.
Okay.
Wall Street goes into panic. And the following Monday, the market sees its biggest single-day drop in history. Things are in absolute shambles. Because how do you start anarchy? You turn a 1 into a 0.
What an interesting
Someone
quote.
who had 1 in their bank account now has 0 because their bank went under. And that happens to everyone. Whoa. Seeing that would happen, on October 3rd, Congress approved it. They approved TARP, the Troubled Asset Relief Program. A program where the government would buy all of the bad assets that these banks had.
Is there a bad side of that?
Just buying assets that were worthless.
Okay.
They were buying bad loans that people weren't going to pay. So that the banks wouldn't have to eat the loss. On October 14th, they gave out the first payment. They gave the banks $104 billion in exchange for shares in the banks. They gave them to 9 banks. Bank of America, Bank of New York Mellon, Citibank, Goldman Sachs, JP Morgan, Morgan Stanley, State Street, and Wells Fargo. Not all of them wanted it. Specifically, I know for a fact that JP Morgan and Bank of America did not want it.
Why not?
They didn't need it.
I think all these banks were.
Not all of them. Remember I told you probably 4 out of the 9 would have survived. Those ones didn't want it. Because
Okay.
they didn't want the government taking ownership in their bank when they didn't need it.
Okay.
They didn't need the money. But they were told it wasn't an option. You know why? Because they didn't want people to know which banks were really in trouble. Because if you see that Merrill Lynch took it and JP Morgan didn't, you're going to pull all your money out of Merrill Lynch. And Merrill Lynch is going to go bankrupt overnight. There's going to be a run on the bank. Everyone's going to try to take out their money, and they're not going to have the cash to cover it.
Mm-hmm.
And then when that bank fails, all the work they did to try to save these banks will fail because everyone will go to the banks and ask for their money.
Okay.
So they forced all 9 of these banks to take it, totaling $104 billion. Citigroup would need extra help. They got a further $20 billion. And then after that, they eventually needed the government to insure $306 billion of their assets. The structure was that Citigroup would pay for the first $10 billion in losses, and the government would pay 90% of the losses after that.
Whew.
On $306 billion. That's really where the story ends. They gave the banks the money, and it did save them in the end.
Did things get
They
wiped
eventually
out?
ended up, because of all this, the problems this caused, they had to give money to companies like General Motors, General Electric, Ford.
So how long did this actual financial crisis?
Well, so let's look at the
Last.
fallout. In 2008, by December, 500,000 people had lost their jobs. In total, 2.6 million people lost their jobs because of this crisis. In 2008, 861,664 people lost their houses. The one silver lining, as of 2020, the government made $121 billion in profit on the money they gave the banks.
Is that a good thing or a bad thing?
It's a good thing. The banks paid back all the government gave them, plus $121 billion. So in the end, the government made $120 billion on this deal.
Wow.
But it took the better part of 10 years. But in the end, they made $121 billion. But there's an important thing to note there. Now the banks know they can take these risks because they know the government will bail them out. They're gonna do it again.
Oh no.
The idea is called moral hazard.
Mm-hmm.
The idea is it's an academic concept that people's behavior will be different if they know the consequences will be handled by someone else. If a bank knows that if all else fails, the government will bail them out, what's to stop them from getting to a point where the government needs to bail them out? And if you look at who was really to blame for all this, number one, it's the banks. They knew how much risk they were taking on. They knew that levered 80 to 1, about a 1.3% change in revenue would mean they were done. The other person that I can really see that you blame is Alan Greenspan.
Who was he in the story again?
We talked about him a little earlier. He was the Federal Reserve Chairman from 1987 to 2006. A really long time for a Federal Reserve Chairman.
Uh-huh.
And he famously took the oath of office with his fingers crossed behind his
that
back.
guy.
He let the banks take these risks. His job was to make sure that the banks remained in a stable position. And he intentionally didn't do it. And that's really where the story ends. In the end, who took the brunt of it? Joe Sixpack. 2.6 million Joe Sixpacks lost their job. 861,000 Joe Sixpacks lost their houses.
Whoa. Wow.
All the bankers were bailed out. All the executives fired, but with multi-million-dollar severance packages. They kept their homes on Long Island and in, the Hamptons.
Mm-hmm.
Because they got a $20 million severance package. And in the end, Joe Schmo ate the cost.
So what is there to take away from this?
Left unchecked, the banks will be greedy. They will take exceptional risk, and at the end of the day, we will have to bail them out. Because if we don't, the whole system goes
So
kaboom.
how can we prevent this?
Don't let them take these kind of risks.
Oh, so nothing we can do. Nothing Joe Sixpack.
The government has to do it. Well, Joe Sixpack can do it by demanding his government representatives make banks accountable.
Okay.
If your congressman doesn't vote in a way that you like on banking bills, don't vote for him. But that'll never happen. Because on the Senate Banking and Finance Committee, would you like to guess how many people have any banking experience whatsoever? No. One person on the Senate Banking and Finance Committee has a background in finance or economics.
Who is it?
I don't remember his name off the top of my head. He looks like a real goober, but he started his own small bank that ended up being worth something like $40 billion or something like that.
Wish I had that kind of money.
As of today, the government has a defined line for banks they will or will not save. It's $300 billion. Banks that hold more than $300 billion are legally considered too big to fail. The technical term is systemically important institutions. They are so important to the economy that they cannot be allowed to fail.
And they just get bailed out no matter what.
No matter what, they'll get bailed out. And eventually, they will need to be bailed out again. Because eventually, we will let them take these risks again.
When do you think the next one's coming?
There's no way to tell, really. It really depends. In all likelihood, it might be different. It might not be houses. It might be something else. They might come up with some other crazy scheme by which they take ridiculous risks. But they'll do it. Because humans are fucking greedy. And they will do it.
Wow.
And at the end of the day, Joe Sixpack will pay for it.
Wow. Well, you all heard it here first. So, do you want to light some of this on fire, or what?
Yeah, I mean...
Yeah, you might as well.
That's the American economy.
What? Alright. I'm Blake Lewis. Kyle O'Brien. Thicc Latin Mindbanger. Thank you for watching.